Excellent, very good. So again, thanks a lot for this opportunity, for this invitation. It's an honor to present at this conference. Actually, I was still working on finalizing this presentation right before the presentation. So I'm looking forward to this presentation and to the discussion. I think this is a reasonably interesting paper for several reasons. The most important reason, I think, is because it connects or tries to connect several threads in the literature, several strands of the literature. It's joint work with Gernot Müller, who's a professor at Tübingen University, and Ben Schumann, who's a PhD student. The paper is about the role of the dollar exchange rate in the transmission of global risk shocks to the rest of the world. And as I said, this is work in progress. So some of the things that I'm going to present today are still in the making, or still in flux. So I see now that I think you can't see the header. So let me switch to the other screen and share that one. Apologies for this. Okay. So I would like to motivate this paper more concretely by showing you these two charts here. What you can see are two prominent episodes. First, on the left-hand side, the global financial crisis, and on the right-hand side, now it's coming. And on the right-hand side, you see the early stages of the COVID pandemic. In both cases, you see the evolution of a common measure of global risk, the VIX, and the dollar exchange rate. When the VIX goes up, that reflects an increase in global risk aversion. And when the dollar exchange rate here, these charts goes up, that reflects dollar appreciation. Now, what you can see quite strikingly in both cases is that there was a sharp spike in global risk aversion, and with a slight temporal delay, there was a pretty sharp dollar appreciation at the same time. Now, of course, these are very prominent, very almost unique events. But even if you look at normal times, if you look at longer stretches of time, then you will still get this co-movement between dollar appreciation and rises in risk aversion. There's also some variation across subsamples, but still you get that pattern that whenever the VIX goes up or the VXO goes up, there's also an appreciation in the dollar exchange rate on average. Now, there's extensive theory that looks at the role of the dollar exchange rate, of dollar assets, of US treasuries in the international monetary system, and that derives then notions such as the US's exorbitant privilege, its duty from some frictions that make these US assets and the dollar exchange rate very prominent. But there's much less empirical work about how the dollar exchange rate contributes to the contractionary effects of global risk shocks. And that's, I think, an interesting gap from a theoretical point of view, because dollar appreciation in the face of global risk shocks has ambiguous effects on the rest of the world in theory. On the one hand, we have this traditional Mendelian expenditure switching. When the dollar appreciates in the face of global risk shocks, then that should switch or move expenditure away from the US towards the rest of the world, as rest of the world goods become cheaper relative to US goods, and that should dampen the globally contractionary effects of global risk shocks. On the other hand, and this is something that has been discussed more recently in the literature, and I'm going to talk about this in more detail later on, there is also a financial channel at play. And through this, dollar appreciation should be amplifying the contractionary effects of global risk shocks. It should be tightening global financial conditions, especially for borrowers that are subject to currency mismatches. So which of those two channels is stronger is an empirical question, and it can be framed in this question here, whether the trade channel or the financial channel dominate. So is dollar appreciation in the context of global risk shocks a curse or a blessing for the rest of the world? And that's what we address in this paper. The approach we take consists in bringing to the data a novel and I think very appealing Bayesian proxy structural VR model for data for the US and the rest of the world over the last 30 years. In this framework, I think there's a very neat way to identify global risk shocks, and that way makes use of high frequency intra-daily changes in the price of gold, the ultimate safe asset, on narratively selected days that are arguably related to global risk events. I'm going to talk about this as well later on in more detail. And then we carry out counterfactual analysis based on minimum relative entropy methods in this Bayesian proxy structural VR framework. The idea here is that we can purge or we can gauge the effect or the role of dollar appreciation for the transmission of global risk shocks by comparing two sets of impulse responses, one from the baseline, which reflects what has been going on in the data over the last 30 years, and one set, which is the counterfactual, and this counterfactual will be characterized by the dollar exchange rate not appreciating in response to global risk shocks. Okay, so that's going to be the core of our paper. At the end, we also carry out a policy experiment, which essentially is just a different way to construct the counterfactual, not based on minimum relative entropy. This policy experiment will just ask the question, what would happen if, in contrast to what we've seen in the past, the Fed surprised markets, surprised the global economy in the face of a global risk shock and just try to stabilize the dollar exchange rate? What would be the outcome in this counterfactual policy experiment? We have a bunch of findings. This is the summary. First, we established that causally, global risk shocks induce dollar appreciation and a rise in risk aversion. And that replicates what you saw on the previous slide, this co-movement between dollar appreciation and the VIX. What we show here is that this is, there is a causal mechanism behind this. Okay, and this causal mechanism, at least in part, is driven by global risk shocks. We also established that global risk shocks empirically induce a global recession that's pretty much synchronized across the US and the rest of the world. And we also provide evidence that is consistent with the trade channel and the financial channel that I mentioned previously being operative in the data. This is reflected by a decline in US exports and US imports, which, however, add up to a decline in US net exports, consistent with the trade channel, predicated on expenditure switching as the dollar appreciates. And on the other hand, evidence that global cross-border bank credit contracts when the dollar appreciates in the face of global risk shocks. And that, again, is predicated on these financial frictions and the currency mismatches on rest of the world borrowers' balance sheet, their foreign currency exposures. So that's the set of baseline results that just establishes where we are, how the world looks like through the lens of this Bayesian proxy structural VR model. And then we ask this question in this general equilibrium outcome, what's the contribution in net terms of dollar appreciation in the face of global risk shocks? Again, we have this financial channel through which the dollar appreciation should amplify the effects of a global risk shock, whereas through the trade channel, it should mitigate the effects of a global risk shock. Now, in this counterfactual, which is characterized by the dollar not appreciating in response to a global risk shock, we find that the global recession is alleviated. Okay, it is less deep. And that implies that dollar appreciation in net terms amplifies the contractionary effects of global risk shocks. And in other words, the financial channel is dominating the trade channel, which I think is let's say, expanding the conventional wisdom about the role of dollar, of exchange rate variation for absorbing the effects of shocks. Now, this is the roadmap of the presentation. I'd like to just spend a couple of minutes on the literature. I'm not going to go into too much detail, but I still find it useful to locate, to position this paper and show how it contributes to what we already know from different angles. Then I'd like to spend a couple of minutes on the Bayesian proxy structure VR model. I'm not going to be too technical, but I still think it's useful to lay out what's so special, what's so novel, and what's so useful for our purposes with this Bayesian proxy structure VR model. And then I'm going to spend the rest of the time on showing you results. Again, both in terms of where we currently are, in terms of the data, but also based on counterfactual analysis. So the paper is, I think, most clearly related to 4 strands of existing literature and informs these strands of the literature. The first is a strand that is theoretical, which studies the role of the dollar exchange rate, dollar assets, treasury assets, as safe assets in the international monetary system. And what we contribute to this strand of the literature is that we explore empirically the mechanisms spelled out theoretically in this literature. So especially we look at the effects of capital flows, cross-border bank credit, risk premia, convenience yields, foreign holdings of treasury assets that has been spelled out theoretically in this literature. And so I think we provide some evidence of which of the mechanisms is empirically valid and relevant and which maybe not. The second strand of the literature is empirical, as are the remaining strands of the literature. This strand of the literature is focused on the relationship between global risk and the dollar exchange rate. But the angle this strand of the literature takes is primarily a forecasting angle or reduced form regression angle. What we contribute here is that we carry out some causal analysis. So we really identify exogenous innovations in global risk, and we document that they are driving the dollar exchange rate and also global risk, which can, I think, rationalize the finding in this literature that global risk measures predict the dollar exchange rate, in sample at least. Third strand of the literature, empirical as well. This strand of the literature is concerned with the role of financial channels in the transmission of global risk and or uncertainty shocks in the world economy. What we do here relative to these existing papers is that we zoom in very explicitly on the role of the dollar exchange rate within a broader class of financial channels. And another thing that we do, which may sound a bit nerdy again, but which I think especially in this in the context of this literature is worthwhile to point out, is that we move beyond the industry standard of these papers, namely recursive identification, if there's identification at all, if it's not just a reduced form regression. And I think that's important to emphasize because there is another strand of the literature, which I'm not quoting here, is more an econometric, a technical strand of the literature, which points out that risk and uncertainty shocks are hard to identify based on recursive identification, or I should say that there are other shocks which have contemporaneous effects on risk and uncertainty. Just think of the Beccari et al. Paper in the JME that shows that US monetary policy is a driver of the VIX, of global risk, or this entire literature on the global financial cycle, which argues that US monetary policy is an important driver of the global financial cycle and global risk in this sense. So the identification that we're going to employ in this Bayesian proxy VR model allows us to not impose recursiveness assumptions. And I think that's important. And finally, there is a literature that does look at the role of the dollar exchange rate in the context of these financial transmission channels for global risk shocks. But this literature looks at microdata. And microdata have lots of advantages. I think one disadvantage is that it is difficult to make aggregate statements based on microdata. But I think as policymakers, we are interested in aggregate statements. So how much is overall for the aggregate economy, the dollar exchange rate contributing to the effects of a global risk shock, for example? Another, again, a bit nerdy issue here is that most of this work just looks at reduced form regressions. It puts on the right-hand side the dollar exchange rate, and it doesn't really identify the source of the dollar exchange rate variation, and so is subject to omitted variable bias. So I think our paper contributes to all of these strands of the literature. It sheds some light on open ends, and it ties some loose ends in these strands of the literature. So let me talk about this Bayesian proxy structural VR model that Arias et al. Are putting out in a paper that's forthcoming in the Journal of Econometrics, but also builds on earlier work that they put out in Econometrica in 2018. The VR model is formulated in a super standard way, at least the starting point. You have the vector of endogenous variables yt, and you have a vector of structural shocks epsilon t. Then we partition this vector of structural shocks into two components, namely one, epsilon t star, with those structural shocks that we're interested in and that we want to identify. And then second, those structural shocks that we're just not interested in, that we're not going to try to identify, epsilon t o. Now, obviously, these structural shocks are unobserved. That's why we need to impose some identifying assumptions. That's why we do this whole business of identification. And what Arias et al. Postulate is that there's an observed proxy variable MT, you may also call this an external instrument, that satisfies two conditions, namely number one, that it is correlated with the structural shocks of interest, with the unobserved structural shocks of interest, epsilon t star, and second, that it is uncorrelated with all other structural shocks, those that we're not interested in and that we don't want to identify. The first condition in a traditional instrumental variables setting is the instrument relevance condition, and the second is the instrument exogeneity condition. Just a remark on the second, we're going to relax this in a robustness check. We're going to relax this assumption that these observed proxy variables, these observed external instruments that we're going to use are uncorrelated with all the shocks that we're not interested in. And we're going to relax this, but for the moment, let's stick with this purest representation of these identifying assumptions. The next thing, obviously, is how do we operationalize these identifying assumptions in a way that's useful? And Arias and co-authors, they suggest to just augment this standard VR model by equations for these observed proxy variables. Okay, so we're going to work with this extended system. And just by looking at equation 2, there are a couple of things that already appear fairly flexible and quite general. The first thing is that these proxy variables, these observed proxy variables MT, are allowed to be serially correlated. Okay, so this is something that previous literature using the traditional frequentist external instruments VR has always squibbled with that these, what does it mean if these external instruments are serially correlated? This is explicitly allowed for in the Bayesian proxy structural VR framework. Also, it's allowed for the lagged values of the endogenous variables in YT to also affect the observed proxy variables MT. That's also fairly general. And third, these proxy variables may also be affected by measurement error in UT. Okay, so be afflicted by measurement error in UT. They may be imperfect measures, almost by design or by assumption of the unobserved structural shocks. So that's fairly flexible. But let me spell out even more explicitly what the appealing features are and what makes this framework particularly useful for our purposes. The first thing is we're going to work with small samples, relatively small samples. That means our estimation should be as efficient as possible, right? Of course, trading off also other aspects, but efficiency is an important aspect. If you look at equation 2, this is a one-step estimation, which is very different from the multi-step estimation in the traditional frequentist external instruments VR model. And it's more efficient to do this in one step, for example, because using this proxy variable MT here informs the likelihood of the reduced form parameters of the VR model as well, which it does not in the traditional frequentist external instruments VR model. Another consequence of this one-step, single-step estimation procedure is that inference is straightforward. You don't have to think about how to carry out the bootstrap in this multi-step estimation in the traditional external instruments VR model, where you have the estimation of the reduced form VR first, and then in the second step, you regress the residuals of the reduced form VR on the external instruments. Here it's straightforward, especially also because this is a Bayesian setting. The Bayesian setting also may accommodate weak instruments. We don't need an explicit theory of weak instruments in finite samples to accommodate this. We can accommodate this by imposing priors on the strength of the instrument, and we can also check how important those priors are for our results. The next thing that I think is particularly appealing is a bit techy, but still I think important to mention, and I mentioned this earlier in the context of the literature. We are going to identify multiple structural shocks with multiple proxy variables. Already to anticipate, we're going to identify a global risk shock. That's our shock of interest, but also a US monetary policy shock. Now, the thing is, when you have multiple structural shocks to be identified with multiple proxy/external instruments VR model in multiple external instruments, then you need additional zero restrictions in order to disentangle those multiple structural shocks from each other that you want to identify. In the traditional frequentist proxy SVR model, you have to identify these additional restrictions on the A0 matrix, or in other words, the contemporaneous relationship between the endogenous variables. And that may be fairly controversial. In the Bayesian proxy structural VR framework, we only need to impose them on the matrix V, that is on the contemporaneous relationship between the observed proxy variables MT and the structural shocks. And I think that's much less controversial than imposing these restrictions on the A0 matrix on the contemporaneous relationship between the endogenous variables directly. And finally, it's also straightforward in this framework to impose additional sign zero and magnitude restrictions to identify yet even more shocks. And we're going to do this later on as well. In this context, also inference is straightforward because this is a Bayesian setting. Okay, so maybe I tortured you with too many technical details, but I think it's important to appreciate that this paper is not only about putting up some interesting impulse response functions, but it's also trying to make some progress in terms of methodology, in terms of technology. Regarding the concrete specification of the VR model, we start with a classic, with the closed economy US VAR of Gertl and Karadi in their AJ macro paper. But obviously we have to augment the VR model by a couple of variables for the purposes of our paper, namely rest of the world industrial production as a measure of rest of the world real activity, the VXO because we want to track the evolution of global risk aversion conditional on a shock to global risk, rest of the world policy rates to observe how rest of the world monetary policy behaves in response to the global risk shock, and obviously the dollar exchange rate. Let me already highlight at this point that the reason why we include the VXO among the vector of endogenous variables is not because it helps or because we need it for the identification of the global risk shock. That's what you would have to do in a VR model with recursive identification. Okay? The reason we include the VXO is simply because we want to track the evolution of a measure of global risk aversion to an exogenous shock to global risk. Our identification of this global risk shock, it rests exclusively on what I showed you in the previous slide, the relationship between the proxy variable we're going to use, and I'm going to talk about this in a moment, and the unobserved structural shock. And I'm mentioning this because you may argue that the VXO is not a measure of global risk aversion. And if you don't use a measure of global risk aversion in your VR, you can't possibly expect to successfully identify a measure of a global risk shock. So again, the VXO is just a measure, a proxy, if you want, for a global risk aversion whose evolution we want to track conditional on a shock. And then also we know that the expected volatility of the US stock market shares a large global component, a common component with the analogs in other countries. So I think for our purposes, that's okay. Let me jump to the proxy variables for the risk shock. For the global risk shock, we use the intra-daily changes in the price of gold, the ultimate safe asset, on narratively selected days that are arguably related to global risk events. This is not something that we propose and introduce in the literature. This was first introduced by Bloom, who identified the days based on very large changes in the VIX. And then Piffer and Podstavsky extended the list of dates. They refined also the selection, and in particular, they introduced the use of changes in the gold price as a given that it is the ultimate safe asset. And then Bobasso and others, they just extended the list of dates. So I'm going to give you examples for days that have been selected by these authors on the next slide, where I show you the time series plot of this risk shock proxy variable. Okay, so again, it's intradaily changes in the price of gold on narratively selected days that are arguably related to global risk events. As I said, later on, we're going to have this policy experiment at the end of the paper, where we explore what would happen if the Fed behaved differently, if it surprised markets and stabilized the dollar. For that policy experiment, we need to identify a US monetary policy shock. And here we just follow the literature, the large and ever-growing literature on monetary policy shocks by using these intradaily changes in interest rate futures around or on narrow windows around FOMC meetings. Just one little remark here. We follow Jaroczynski and Karadi from the AJ macro paper, and we separate pure monetary policy shocks from central bank information effects, exploiting the correlation between stock market surprises and interest rate future surprises around these FOMC meetings. Yes, one more thing. As you will see, we're going to add additional variables one at a time to this VR model in order to explore extensions, to explore predictions from the theoretical literature beyond our baseline. We're going to do this in a sequential way, adding variables one at a time and re-estimating the VR one at a time, because we want to stick with flat priors. At least for our baseline. However, I'm going to show you results as well from a large Bayesian VR model, which includes all these variables simultaneously, but which is estimated using informative priors. The sample, as I said, covers the last 30 years. Still, for the number of variables that we're actually interested in, the degrees of freedom are not too comfortable. And we impose this, at least in our baseline, this relevance prior that can address the issue of weak instruments by assuming that 10% of the proxy variable variance, these high frequency gold price changes, are accounted for by the unobserved structural shocks. The reason we do this is really not so much because our results depend on this. Actually, they are hardly distinguishable from the case when we don't impose this relevance prior. We impose this in particular to be consistent with what those two papers that have also applied this Bayesian proxy structural VR model that we know are doing. Caldara Habs in their JME do this, and Arias et al. In their forthcoming Journal of Econometrics paper do this. Okay, so here is the time series of the monthly gold price surprises and the interest rate futures surprises. Let me focus on the gold price surprises. Remember, the proxy variable is constructed at the daily frequency. These are daily, intra-daily changes in the gold price on narratively selected dates. Our VR is estimated at the monthly frequency, so we have to temporarily aggregate these daily gold price surprises to the monthly frequency. We follow here, get like a radi again in the temporal aggregation. But what you see here is a monthly time series plot. And you see that there are not too many non-zero observations, and these are gold price surprises. There are some pretty large ones, and those ones are also the most prominent ones. So for example, here at the beginning of the 19th, we have the Iraqi invasion of Kuwait, which triggered the US response. Then we have the terrorist attacks at 9/11 at the beginning of the 2000s. Later, we have the height of the global financial crisis when Lehman collapsed and AIG requested emergency liquidity. And then we have here the publication of the outcome of the Brexit referendum. This solid black line just indicates the time after which we have to update the list of events by the work of our colleagues at DCB, Bobasu, and colleagues. Before this is Piffer and Potsavsky building on Bloom's work. Okay, now I have to say that this is something, the precise construction of this proxy variable, that is still a bit work in progress. We're exploring several dimensions of robustness and sensitivity here, but I'm not going to focus on this today. Let me show you the results. These are the baseline results. These are the impulse responses to the global risk shock identified by this proxy variable, these intra-daily changes in the gold price aggregate to monthly frequency. In the first column, you see the responses of the VXO and the dollar exchange rate. Again, when the dollar exchange rate goes up, that's an appreciation. And what you see is that the global risk shock pushes up the VXO. It increases global risk aversion, and at the same time, it causes a dollar appreciation. I'd like to emphasize again one thing: the finding that the VXO goes up here is not hardwired into the estimation, as it would be, for example, in a VR with recursive identification. There, you know, when you shock a particular equation, then by construction, the variable whose equation you're shocking is going to go up on impact. This is not so in this framework. So our finding that the VXO goes up is really something that the data are telling us. So these two panels in the first column therefore replicate what you saw on the first slide, but they replicate it with a causal flavor. It's global risk shocks that are causally driving both the increase in global risk aversion and the dollar appreciation. In the second column, you see that this global risk shock is globally contractionary. US and rest of the world industrial production both contract. And what's interesting is that US industrial production contracts somewhat more strongly, which turns out to be, however, consistent with theoretical work that highlights that the reserve currency issuer is bearing the brunt of the of safety shocks. So that's not something that's inconsistent intuitively. Here you see the responses to additional variables in the VR, just to give you a little bit more context on what the data tell us. We have that the excess bond premium rises. There's some delayed overshooting there. US monetary policy measured by the one-year treasury bill rate in the middle panel, it loosens, and the rest of the world policy rate also drops, reflecting monetary policy loosening in the rest of the world as well. So I think all this is plausible. What I would like to show you next are a couple of extensions that go beyond the baseline specification of the VR model. I think these extensions are useful because they lend further support to our interpretation of this shock as a global risk shock. You may still question whether whatever we identify there is really a global risk shock or something else. And I think by checking additional predictions from the theory in terms of impulse responses, how they should relate, how other variables should relate to global risk shocks, helps us to lend further support or credibility to this interpretation of global risk shocks. The first extension relates to the response of the treasury premium and treasury foreign holdings of treasury securities. This is interesting because theoretical literature, Young and others have a paper in the Journal of Finance, the theoretical literature which argues that US Treasury securities carry a convenience yield, which is a non-pecuniary return for investors holding these assets, for example, because US Treasury securities provide liquidity services. What that literature argues or discusses and shows also empirically is that the convenience yield of US Treasuries rises relative to the convenience yield of other G10 sovereign bonds in times of elevated stress. And that's that difference between the convenience yield of the US Treasury securities and other G10 sovereign bonds is called the US Treasury premium by Du et al. And what we find is that the US Treasury premium indeed increases in response to the global risk shock that we identify. In other words, the convenience yield, the non-pecuniary return that investors derive from holding treasuries rises more than the convenience yield that they derive from holding other G10 countries' sovereign bonds. And that's consistent with what this literature, this theoretical literature on the special role of the US dollar and US Treasury yields would predict. The second thing is that in this theoretical literature, at least some of the models, some of the papers predict that in the context of elevated global risk, there will be a physical run to safety. In other words, there will be capital flows into US Treasuries. Okay, that's not a feature of all the theoretical models in this literature, but it's a feature of, for example, the model in Majori or in Jiang, Krishnamurti, and Lustig. And so what we find, I think you already spotted this on the right-hand side panel, is that indeed in response to a global risk shock, there is an increase in foreign treasury holdings in foreign treasury holdings. Just one side remark here. I showed you at the very beginning as a motivation what happened during the early stage of the COVID pandemic. Remember that our sample for the VR doesn't cover the COVID pandemic. And that's important because what we observed during the COVID pandemic is that investors were so desperate that they even shed treasuries because they were just running for dollar cash. So that is possibly a contradiction to this impulse response here, but at the same time, that episode is not in the sample that we consider for the VR model. Okay, the second extension that we consider, and that I think is also quite interesting and useful to lend further support to our interpretation of this shock, is to look at the response of other currencies to the global risk shock. There's some literature which classifies currencies into safe haven currencies and non-safe haven currencies. Typically, what this literature comes up with is a very narrow set of safe haven currencies, the Japanese yen and the Swiss franc. And what we find is that indeed, in response to a global risk shock, the Swiss franc and the Japanese yen, they both appreciate alongside with the dollar, while the euro exchange rate made up of legacy currencies for the time period before 1999, and the British pound, they actually depreciate in response to global risk shocks. So again, this is consistent with what we would expect against the background of this literature on safe haven currencies versus non-safe haven currencies. The next three bullets are to provide you with additional context. The first one is looking at the effects of these global risk shocks across advanced and emerging market economies. It splits the rest of the world into two regional country group aggregates. And what you see is in the top row that the contractionary effect in terms of industrial production and in advanced economies and in emerging market economies is very similar. At the same time, in the bottom panel, you see an interesting divergence, an interesting asymmetry in the sense that monetary policy in advanced economies loosens in response to the contraction caused by the global risk shock, whereas emerging market monetary policy tightens. Now, that may be surprising at first sight, but if you think of fear of floating, then that is not controversial anymore. That's actually quite interesting, but we're not following up on this furthermore in this paper. This relates to a large literature arguing that exchange rate pass-through is very large in emerging market economies, partly because of dominant currency pricing, the invoicing of large shares of global trade in dollar. And so when the dollar appreciates, then especially in emerging market economies, that has a big impact on import prices. That then relates to a new evolving strand of the literature in the heterogeneous agent New Keynesian tradition, whereas it is in which it is shown that exchange rate depreciations have a large impact on disposable incomes, or real disposable incomes, and large real effects. That relates to a large literature on financial channels, which argues that exchange rate depreciations can jeopardize financial stability. So I'm not going to go into this more, but I think it's a fairly interesting result and actually consistent with quite some existing and very recent literature. Okay, so just for those interested, we also explore the effect of a global risk shock separately on the price and the quantity of risk, so not only on the VXO overall. We make use here of a decomposition suggested by Bickhardt and co-authors that they have been working on in several papers. It's based on the VXO, but it decomposes it into the quantity of risk component, uncertainty, and the price of risk component, risk aversion, literal risk aversion. And as you can see here, both increase in response to a global, what we call a global risk shock. Okay. Again, I'm not going to go further into this, but just to address questions from people who are interested in whether this is more a global risk or a global uncertainty shock. Well, you can interpret it, I think, in both ways without losing much understanding. Okay, and then there are some interesting sensitivity checks, which I think again provide further context. The first one is based on an argument in the literature that that uncertainty shocks are just demand shocks. And what we do here is we exploit this appealing feature of the Bayesian proxy structure VR model that we can identify additional structural shocks using psi and zero magnitude restrictions without complicating our life significantly. And this we do for a global demand shock, which we identify by sign restrictions. And we find three interesting things. The first interesting thing is that the effects of a global risk shock and a negative global demand shock are similar in terms of the VXO and similar in terms of real activity. That's the first column and the last column. However, there are interesting differences. The first interesting difference is that in case of a contractionary global demand shock, the dollar is, let's say, there's less action in the dollar exchange rate than in case of a global risk shock. The dollar seems to appreciate, but definitely doesn't do so on impact, while it appreciates on impact and even further on later in case of a global risk shock. So that's the first distinction. More interestingly, is if we augment the VR model by the gold price at the monthly frequency, and that's really the gold price itself, not the surprises in the gold price on these narratively selected dates, that's the gold price itself, then the gold price increases in response to global risk shocks, but it falls in response to a global demand shock. And again, this is not hardwired into the model because we use these gold price surprises on narratively selected dates as a proxy variable. This is really something that the data tell us. So there are interesting differences between the global risk and the global demand shock, meaning that we're very unlikely to be confounding global demand and global risk shocks. Second sensitivity analysis relates to what I said, that the exogeneity condition, that the gold price surprises are uncorrelated with all non-global risk shocks. And that's, I think, an interesting sensitivity analysis, because you may argue, well, look at the list of the dates identified by Piffer and Podstavsky. There are certainly some events which you wouldn't necessarily only, at least, call a global risk event. Maybe you would label them different. And we could then start a long discussion about how to label these and whether we should consider these dates. I think a better way to address this possible concern is to just relax this identifying assumption and to say, okay, maybe these gold price surprises are not only driven by global risk shocks across all these events identified by Piffer and Podstavsky, but maybe they're also driven by other structural shocks. Let's just only impose that the biggest effect, the biggest driver of these gold price surprises is the global risk shock, but maybe not the only one. And what we get in this case is actually very similar to our baseline. So the bands are wider, which is not surprising given that we impose weaker restrictions, but otherwise the results are very similar. So again, I think we're fairly safe on that side. Next thing is based on literature that argues that there are important changes over time in the relationship between global risk and the exchange rate, especially the paper forthcoming in the Review of Economics and Statistics by Lilly and co-authors, Lilly, Majori, Nyman, and I think Schrager, if I'm correct, which argues that global risk has been predicting the dollar exchange rate only after the global financial crisis, but not before. So what we do here is just a simple sample split. We have the baseline in the top panel. You see that these global risk shocks in the pre-global financial crisis period had a clear impact on global risk aversion, and they also appreciated the dollar exchange rate. And I think one possible explanation for this finding that stands in contrast to what Lilly and co-authors find is that we look at identified exogenous innovations to global risk, whereas they look at reduced form regressions, at forecasting regressions. And it may well be that prior to the global financial crisis, the primary drivers of the data were shocks that did not have a large impact on global risk, on the VXO, while they did have an important impact on the dollar exchange rate. By identifying exogenous variation, we circumvent that reduced form obstacle in a way. Okay, then as I said, we also estimate this large Bayesian VR where we include all these variables. I'm just putting this up to show you that additional variables such as rest of the world equity prices and US equity prices also contract in response to the global risk shock. Then I've skipped the evidence on the relevance prior. Well, let me show you this for completeness because I want to make sure that nobody thinks our results depend on this relevance prior. You hardly see any differences here when we impose or don't impose this relevance prior. Bands are a little bit wider. Again, you would expect that if you don't if you don't impose any prior. Okay, let me move on more specifically to the role of the dollar exchange rate, to the role of dollar appreciation. But let me spend a minute or two on refreshing our minds on the trade and the financial channel, just to make sure that we're on the same page. So the trade channel is predicated on expenditure switching. In this case, we have that dollar appreciation makes rest of the world goods cheaper relative to US goods. That induces expenditure switching away from US goods towards rest of the world goods, both in the US and in the rest of the world. In other words, dollar appreciation leads US imports from the rest of the world to rise and US exports to the rest of the world to fall, resulting in a decline, in a drop in US net exports, and as a mirror image, an increase in rest of the world net exports. And overall, dollar appreciation would dampen the contractionary effects on the rest of the world through the trade channel. Now, I outlined this, thought experiment here based on the assumption of producer currency pricing, that export prices are sticky in the currency of the exporter, but actually, at least qualitatively, the same result obtains if we go with dominant currency pricing, namely that export prices are sticky in US dollar. The only thing that changes is that we don't have expenditure switching in the US itself, but we still have expenditure switching in the rest of the world. So qualitatively, we still have a decline in US net exports and an increase in the rest of the world net exports. On the other hand, we have the financial channel. This one is predicated on financial frictions, and in particular on financial frictions that give rise to rest of the world firms and households borrowing in foreign currency, in particular US dollar, it turns out in the data. And this means that rest of the world agents are subject to currency mismatches on their balance sheet. When the dollar appreciates, that reduces their net worth and makes them more risky investments from the perspective of globally active banks. As most of these banks operate under value at risk constraints or similar constraints, they have to cut their lending to these borrowers which have become more risky in response to the dollar appreciation. And so dollar appreciation is associated with a tightening in global financial conditions, and thereby dollar appreciation should amplify the globally contractionary effects on the rest of the world. Right? And so you see here again, there are these two channels that work in opposite direction, and we're just aiming to assess which of these two is stronger. Before I move on to assessing precisely this, let me show you these three impulse responses which document that, or which suggest that the trade and the financial channel may be operative in the data. You see here that US real exports and US real imports drop in response to a global risk shock. US real exports drop immediately and more strongly than US real imports. Interestingly, this is consistent with dominant currency pricing, namely that the prices of US exports are sticky in dollar. And so when the dollar appreciates, that leads to a contraction in exports and that leads to expenditure switching right away. While when the prices of US imports are sticky in dollar, then there will not be any expenditure switching, at least in the short term. And so US imports don't contract by as much. Overall, you can see from this picture, however, that there's a contraction in US net exports, which is what we would expect if a trade channel was operative in the data. And in the right-hand side panel, you see a reflection of the tightening in global financial conditions, namely that cross-border bank credit to non-US borrowers, we net out the borrowing of US agents here. Cross-border bank credit to non-US borrowers also collapses significantly in response to this global risk shock. Good. So what's the net contribution of dollar appreciation? The way we assess it is that we compare two sets of impulse responses. One impulse response is what you already saw. These are the baseline impulse responses. And the benchmark is a set of counterfactual impulse responses. And that counterfactual is characterized by the dollar not appreciating in response to the global risk shocks. We apply minimum relative entropy methods in order to construct this counterfactual. We apply this in the context of impulse responses, while it has so far, at least to the best of our knowledge, been only applied in the context of forecasting. Just to give you an example, Robertson and co-authors, they improved their forecasts of the federal funds rate, of US inflation, the unemployment rate, by imposing on their forecast the constraint that on the inflation forecast in particular, that it equals 2% over a 4-year horizon, consistent with the Fed's target, let's say. Okay, but if you think about impulse responses just being based on conditional forecasts, then I think the analogy between what we're going to do in the context of impulse responses and what existing literature has done in the context of forecasting is fairly obvious. I'm not going to go into technical details of minimum relative entropy. I'm just trying to give you an intuitive idea of what it does. Minimum relative entropy seeks to determine that counterfactual VR or a counterfactual VR in which global risk shocks do not appreciate the dollar. Or in other words, it seeks an alternative parametrization of the VR model, with that parametrization implying that the impulse response of the dollar exchange rate to a global risk shock is just zero. Okay? Now, in general, there are many different alternative parametrizations of the VR model that are characterized by the dollar not responding to a global risk shock. And the neat thing about minimum relative entropy is that it determines that alternative parametrization, that counterfactual VR model, which is, roughly speaking, minimally different from the actual VR model that we estimate from the data. Okay. So even more intuitively, what it does is that it determines that counterfactual world out of the infinitely many possible counterfactual worlds, that counterfactual world which is minimally different from the actual world, with the sole difference that the dollar does not respond to global risk shocks. Finally, an important remark is that minimum relative entropy is agnostic regarding the structural forces that prevent dollar appreciation in this counterfactual. So it's agnostic about whether in this counterfactual world a particular friction is not present, or in this counterfactual world policy just behaves differently. Minimum relative entropy does not tell us anything about why the dollar doesn't respond in this counterfactual world. It just tells us how does that world look like in terms of impulse responses of the other variables in the VR model. This is a key result of the paper. What you see here is the impulse response of rest of the world industrial production to the global risk shock. The blue solid line shows you what we got in the baseline, and the red circle line shows you what we get in the counterfactual. Again, the counterfactual, which is characterized by the dollar not responding to a global risk shock. And what you see here is that there is a significant, economically significant difference between the effect of a global risk shock on rest of the world real activity across the baseline and the counterfactual. The contraction is much weaker in the counterfactual when dollar appreciation is absent. So what we conclude from this chart here is that in net terms, on balance, dollar appreciation amplifies the globally contractionary effects risk shocks, or in other words, the financial channel trumps the trade channel, which again, I think is an interesting finding against the background of conventional wisdom that attaches a lot of an important role to the exchange rate as shock absorbers. Okay, now here again, to provide you with a little bit more context, these are the results of the counterfactual for the variables that reflect the trade and the financial channel. What you see here is that in the counterfactual, without dollar appreciation, there's hardly any difference in the response of US exports and US imports. US exports do fall a little bit less, and US imports do fall a little bit more, at least at short horizons, which is consistent with what you would expect in the absence of expenditure switching. But the difference are really, really very small. So already this tells us or suggests that the trade channel cannot be very strong. At the same time, in the right-hand side panel, we see that there's a very different response of cross-border bank credit to non-US borrowers when there's no dollar appreciation. And so again, this suggests that the financial channel turns out to be much more important quantitatively than the trade channel. I want to address one concern here right away, namely that cross-border bank credit in the BIS data is recorded in dollars. Obviously, there's not only cross-border bank credit denominated in dollars out there in the world. There's also euro cross-border bank credit and yen cross-border bank credit. Now, we saw earlier that the euro depreciates in response to a global risk shock. So you may argue, well, this contraction in global cross-border bank credit that we get here is just because this, in the statistics, is recorded in dollar, but involves euro cross-border bank credit as well. So in other words, this is just a mechanical valuation effect. So we do two things to address this. One, we only look at cross-border US dollar denominated bank credit, and we look at exchange rate adjusted total cross-border bank credit. It's a very coarse adjustment, but still it's there in the BIS statistics, so we use this. And in both cases, you see that, yes, this difference between the baseline and the counterfactual is smaller, but it's still much bigger than for US exports and US imports. Another thing that we do is, again, a placebo test. Remember, we also found that the yen appreciates in response to a global risk shock. And so what we ask here is that, well, let's do an alternative counterfactual, one in which we prevent yen appreciation and not dollar appreciation. And what we find is that in this counterfactual in which the yen doesn't appreciate to a global risk shock, while the dollar still appreciates, there's actually no difference. So yen appreciation is actually inconsequential for the global transmission of a global risk shock, right? It's the dollar exchange rate which is special. And why the yen doesn't play any role? Well, if you look at the amount of cross-border bank credit that is denominated in yen, that's the blue line, and compare it with the amount of cross-border credit in dollar, that's the orange dashed line, there's a big difference. And also, as argued by the QJE paper of Vivashina et al., yen cross-border bank credit is funded by much more stable sources, secured deposits in particular, which are much more resilient to global risk shocks than the unsecured funding in the money markets in the US, at least over the sample period that we look, over large stretches of the sample period that we look at. Okay, let me move to the policy experiment. So here what we do is a different counterfactual. We don't apply minimum relative entropy. We consider a counterfactual that is very specific about the reasons why the dollar doesn't appreciate in this counterfactual. And in particular here, we're going to assume that in contrast to what we have observed in the past, US monetary policy, the Fed steps in and it surprises the markets and it stabilizes the dollar exchange rate. In order to implement this technically, we need US monetary policy shocks. That's why we identified a second structural shocks with a second proxy variable earlier. And we let every period along the forecast horizon, along the impulse response horizon, we let a US monetary policy shock materialize. And the size of that shock is chosen precisely in order to keep the dollar exchange rate at a baseline. This is the result. You see in the lower left-hand side panel that the dollar exchange rate is stabilized. You see also in the top left-hand side panel that this also implies that global risk aversion is stabilized, not exactly at zero, but it's still stabilized around zero, even somewhat mitigated relative to baseline. In the middle lower panel, you see that in this policy experiment, the Fed would also stabilize or dampen the contraction in the rest of the world. So in that sense, this would be a positive. However, you see in the top middle panel that US industrial production would overheat, would overshoot, at least at medium horizons. And in the lower right-hand side panel, you would see that this would lead to to price pressures in the US. US consumer prices would actually rise relative to baseline. So this implies important trade-offs, at least from a global perspective. From a US perspective, it's clear that to the extent that the Fed cares about US consumer prices and US unemployment, it's clear that it's not optimal for the Fed to intervene in this way. However, from a global perspective, that raises important questions about welfare, whether it would be globally optimal for the Fed to behave in this way to mitigate the contraction in the rest of the world, all the while it would have to to experience these price pressures in the domestic economy. Okay, so I'd like to stop here. As I mentioned, this is a work in progress. We are still working along a couple of dimensions, but I think already so far, some of these findings are reasonably interesting. We established that global risk shocks have a large effect on the global economy, that they induce dollar appreciation and a concomitant rise in risk aversion. So they replicate what we observe during prominent episodes that we identify narratively as global risk events, such as the global financial crisis or the early stage of the COVID pandemic. And we established that these global risk shocks induce large and synchronized global recessions that are associated with declines in trade, with contraction in capital flows, cross-border bank credit, and tightening global financial conditions. We find that in net terms, dollar appreciation is actually a curse rather than a blessing. The financial channel dominates the trade channel. If the dollar did not appreciate in the face of global risk shocks, we would observe a contraction in the rest of the world that would be significantly smaller than what we actually observe. In principle, US monetary policy could stabilize the dollar and thereby mitigate substantially the global contraction, but the obstacle for the Fed doing this are the implications in the US economy. Now, we can have an interesting discussion here about the Fed's behavior during the early stages of the pandemic, where it provided emergency liquidity to the rest of the world. It would be an interesting discussion to have how this is parsed into our framework here in terms of the measure of US monetary policy, and if that dimension of US monetary policy would also involve those trade-offs for let's say, a world a social planner, in the sense of leading to price pressures in the US while having these dampening effects in the rest of the world. So with this, I'd like to close here, and I'm very much looking forward to questions and a discussion that's going to hopefully come.
Lovely. Thank you, Jorgo. That was great and interesting.